Oh, hello?
Hi. Hi, how are you?
Hi.
Is that Rowan? Who's that?
Yes, this is our investment club, and more students
Okay.
on the way. So we'll just get it started right now. So everyone, this is Howard Marks. We've been talking about him for the last two meetings that we've had. We've talked about his memos and we've talked about his investing style. So it's mainly going to be a Q&A, which I'll start and end. But those who have questions assigned, who submitted questions, you guys know who you are, and we'll be calling you up to ask your questions throughout this whole guest speaking session. So I guess I'll start it off. So in your 2015 memo, Risk Revisited Again, you mentioned more than 20 types of risks investors face. I think the number was 24. How does an investor manage all those risks?
Well, some are more important than others, and even some of the ones I included were tongue in cheek. But I think, like anything else in life, if we have to deal with multiple factors, we have to prioritize. So the main risk, I've kind of evolved my way of thinking or my way of talking about it, because I think in that memo I said that the main risk is the probability of losing money, permanent capital loss. And now what I would say is that the main risk is the risk of unfavorable outcomes, which is slightly different. Usually, uh, losses are the most unfavorable outcome, but there are other unfavorable outcomes. And an example is that an insurance company has to make 7% on its portfolio, so making five would be an unfavorable outcome. And it's obviously not a loss, but it's falling short. Uh, Equally, um, if you're a professional money manager in, let's say, the tech space, and Apple stock goes up 30% and you don't have it, that's an unfavorable outcome. It's a risk to you in your profession. It's not a capital loss, but it's unfavorable. So I think the best way to think about risk is the probability of unfavorable outcomes. That's the one we worry about. Now, for obviously some of the, as I indicate, some of this is subjective, and for some people, some things that represent unfavorable outcomes for some people are not unfavorable for others. There is a matter of subjectivity to it, but I would say that it's a matter of prioritizing the things you have to worry about, and then worrying like crazy.
Okay. All right. So we got Matthew. He's going to ask our first question.
Hi, I'm Matthew Lim. In one of your memos in Race to the Bottom, you mentioned about overpriced markets. What red flags and metrics should investors look for that indicate an overpriced market and or a bubble, and how should investors deal with them across assets?
Well, there are two categories of things to look at. Usually they're connected. One is quantitative, one is qualitative. The quantitative is valuation. So for stocks, PE ratio; for bonds, yields and yield spreads; for real estate, capitalization rate, that is to say the net income as a percentage of the cost, and a number. And in private equity, it's enterprise value. It's the price being paid as a ratio of the company's EBITDA or cash flow. So all of those are quantitative, and all of those are indicators of risk, of whether the market is elevated. Now you can look at them relative to the history for that parameter, or relative to the history for that parameter for that company or stock, and you can look at it for relative to other stocks. But so there's nothing that can be used as an automatic signal. Everything is subject to interpretation. But you want to look at the quantitative valuations. And then there's the qualitative, Matthew, which is what I call taking the temperature of the market. And you want to assess the emotion that is prevalent in the marketplace. For example, when optimism is high, assets will tend to sell high relative to their intrinsic value. When investors are driven by greed to make money and not too conscious of fear of losing money, you have to assume that prices may be high relative to intrinsic values. When people are, I was discussing the different types of risk. When people are more afraid of FOMO, the fear of missing out, then they are afraid of losing money, then you have to assume that maybe prices will be high relative to intrinsic value. When bullish prognosticators are in demand on TV, when bullish books are being written, when newspaper articles tout this as the last great opportunity to get on board before the thing goes to the moon, all of those things are indicators of a hot market. I wrote a memo in September called "The 7 Worst Words in the World," and I talked about first-time funds. And lately, there's been a lot of first-time funds raised for private credit investing. And when a first-time fund means a manager who's never raised a fund before goes out to raise a fund. And if it's easy for first-time managers to raise funds, then that's an indicator that emotion is high. Psychology is high, and something you want to watch out for. If somebody's raising a fund for the first time, he comes out and he says, I've never done this before, but I'd be willing to try with your money. And if people rush that manager to give him money, then you have to conclude that that's a bullish market in which people are optimistic and not risk averse. And when that's the case, you want to know. So those are examples of some of the qualitative factors that contribute to a high temperature for the market.
All right, so our next question comes from Caden.
So in your opinion, when should investors be aggressive and when should they be cautious?
Now that's what we call a softball. Thank you. How much did I pay you to ask that question? Investors should be aggressive when prices are low relative to intrinsic value, and defensive, cautious, when prices are high relative to intrinsic value. And when are prices high relative to intrinsic value? When the economy is doing well, companies are reporting good earnings, the market has been performing well, emotion is positive, investors have made a lot of money and feel good about it and are willing to buy more. People who haven't been in the market have to look on as other people make money. They feel terrible about that. They want to start to buy. And people interpret risk bearing as their friend. And when are those things seen? At market highs. So when things are going well and everybody's optimistic and greedy, that's the time for caution, and vice versa.
All right, so our next question comes from Cassandra.
Hi, I'm Cassie.
Hi.
So you said timing events in the market's pretty difficult, almost impossible, but to what extent can market cycles be known if timing can't be known?
The pattern of a cycle can be understood. We can have a sense, I think it was Matthew who asked the question, how can we tell when things are high or low? We can have a sense for whether things are high or low, whether the market is high in its cycle or low in its cycle. We can have a sense for what's going on around us. And maybe you haven't read my book, which I put out in October. Most of these answers are in there. It's called Mastering the Market Cycle. I think each of you should buy at least 3 copies. But where the market is in its cycle influences the probabilities of future gains or losses. It doesn't determine them, it influences them. And I think that the one thing I'd like everybody in the class to understand is that we sometimes have a sense for what's going to happen, We never know when. So when Cassie uses the word timing, that suggests a sense or a desire to know when things are going to happen. And we never do. But we can, based on what's going on, we can have a sense for what's going to happen. Well, what does that mean? If a security is overvalued, we want to either underweight it in our portfolio or eliminate it entirely. When a security is overvalued, that means it's more likely to go down than up. Or if the market goes up, that security is more likely to underperform going forward. So we understand what the valuation implies for the future. We understand the ramifications of where we are in the cycle for future potential developments. But we don't know when it's going to happen. If a security is overpriced, that does not mean it's going to go down tomorrow. Lots of securities that are overpriced become more overpriced and more overpriced and more overpriced. And when it goes on for a long time and to a great extent, that's how we get bubbles. So this is a great example. The fact that we know it's overpriced does not mean that it's going to go down tomorrow. We know what is likely to happen, which is to say that its performance should be somewhere between anemic and negative, but we don't know when that's going to occur. And, you know, just you have to always think about this. If overpriced meant that it's going down tomorrow, then nothing would become extremely overpriced because excessive prices would always be self-correcting, and they're not. And because things can go from overpriced to more overpriced to even more overpriced to maximally overpriced, that's how we get bubbles. And the mere fact that we do get bubbles from time to time proves that these things are not self-correcting. We sometimes understand what's going on in the market. We sometimes understand what that implies for the future. We never know when the implications are going to actually take effect.
All right, so our next question.
Evan. Hi, I'm Evan. So in your memo, Risk Revisited Again, you talk about investing as a double-edged sword and showed how diversification is one of those double-edged swords. In regards to diversification, when is it good to have a more concentrated portfolio, and when is it good to have a more diversified one?
Well, that's a great question, Evan. And here's an answer, which a way of expressing it, which I've come to recently. I don't think I've ever written this in a memo. You can correct me if I'm wrong. But let's think about diversification. Why do we diversify? We diversify to protect against what we don't know. We concentrate to put to work what we do know. So most people think they know something, but they don't know everything. So they don't diversify extremely, but they diversify somewhat. Now, I went to University of Chicago, as you may know. Roughly, I arrived there 52 years ago, and they were just starting to teach what's called the Chicago School of Finance Theory or Investment Theory. And one of the things that was pointed out to me was very interesting. So something called risk aversion underlies all intelligent markets. Risk aversion means simply that people don't want to lose money, and holding on to what they have is more important than maximizing the addition. Most people apply a certain amount of emotion to the loss of money. Let's say you lose $1,000, you feel this bad about it. You make $1,000, you feel this good. So the quantum of emotion that applies to a given gain is usually less than the quantum of emotion that applies to a given loss, which is to say most people value losses more than they do gains. People are risk averse. How do we know people are risk averse? How do we know people don't want to lose money? How do we know that they would rather sub-optimize and reduce their potential return in order to avoid a large loss? And the proof, I was told back in 1967, was that nobody has a one asset portfolio.
Seems like kind of frozen.
Oh, can you not hear me, Rowan?
Yeah, it kind of froze up for a sec. Could you just repeat?
Well, what I
Kind
said
of.
is the way we know that everybody is risk averse is the fact that everybody diversifies. Nobody, I've never met anybody who has a one asset portfolio. Everybody in the stock market, for example, has one stock they like better than all the others. But I've never met a person who only holds one stock. So they may emphasize their favorite stock because of what they feel they know, but they diversify and include stocks that they like less because they're afraid of what they don't know. So there's your answer, Evan. It's not a very helpful answer, but we should concentrate our portfolios when we're confident of our judgment, but we should diversify our portfolios when we don't want to take excessive risk based on our judgment. What that means is we should balance concentration and diversification all the time. Now, the more risk-averse person you are, the more likely you are to diversify. The risk taker is going to concentrate, and once in a while he's going to put all his money on black, and it comes up red, and he's out of the business. The diversifier, by definition, never has a big loss, and he never has a big gain.
All right, so our next question comes from Rajan.
Hi, I'm Rajan. And when you are investing, how do you find asymmetric investments of sorts where the upside potential prevails over the downside?
Well, number one, as Rajan indicates, that asymmetry, what I call it, is what we all want. If you're buying assets you buy a stock, you think if things go well, you'll make 30%. If things go poorly, you'll lose 30%. There's nothing great about that. What we want to find is securities, investments, where the upside potential exceeds the downside risk, where we think there's a 50% gain chance of a 30% gain and a 10% chance of a 30% loss. That would be a great investment. Now, how do you find them? Number one, everybody in the class should bear in mind that by definition, it can't be easy, because too many people are looking, and they're all intelligent, and they're all computer literate, and they all have access to data, and they're all highly motivated. Too many people are looking for what I would call, what the Chicago School called a free lunch, to be prevalent. It can't possibly be that you walk out of this classroom and you turn to the left. Oh, there's something that can go up 30% but not down 30%. There's something that can go up 40% but only has 10% downside. There's something that can go up 50% but only 15% downside. They can't be all over the place because so many people are out there trying to find them. And if they find them, they buy them. And if they buy them, number one, maybe they disappear, or number two, their process of buying them bids up the price so that they're not a free lunch anymore. So everybody in the class, anybody who's going to try this activity, should be chastened and should not expect to find a lot of free lunches. It just doesn't make any sense that there should be a lot of free lunches around. Now, every once in a while there is. And Rajan, the question of how you find them is not something I can answer for you. I couldn't answer it. I don't know if I could ever answer it, but I certainly can't answer it in the time span that I have here. You have to look, You have to analyze. You have to reach your conclusions about what is the upside potential and what is the downside potential. You have to test your assumptions. You have to ask yourself if you're really being realistic or are you being biased. Sometimes people are biased because what? Everybody wants to find these things. There's a human temptation to believe that you have found them. But as I say, it can't be that easy to find them. So you have to do a lot of looking and a lot of work. And you just remember what John Kenneth Galbraith said. He said, and he exaggerated, of course, but he said, maybe in direct answer to your question, Roger, there is nothing intelligent to be learned about making money, because if there were, study would be intense and everybody with a positive IQ would be rich. Nobody can teach you, nobody can give you an instruction sheet which says if you do A, B, C, D, and E, you'll find asymmetries. Because if it could be reduced to a dependable, repeatable process that everybody can implement, asymmetries would all disappear like that. So you have to look for them. You have to understand the importance of finding them, but you also have to have the necessary skills and judgment. And, you know, in basketball, there's a saying, you can't coach height. And investing, you need superior insight, and you can't coach superior insight. Either you have it or you don't.
All right, so our next question comes from Rushil. It's coming up.
Hi, I'm Rushil. And my question is, how did your educational background help you in finance?
Well, my educational background was essential for getting me going, getting me on my career path. When I got to Wharton in 1963, I knew nothing about finance and investing, and I learned about security analysis, stocks and bonds, accounting, all economics, macro, all the things you have to know to be able to understand companies, securities, and the environment. Then when I went to Chicago in 1967, my quantitative practical Wharton education was paired with a qualitative theoretical education at University of Chicago, which taught me about things like I've been talking to you, risk aversion, the scarcity of free lunches, which is described as the efficient market hypothesis, and so forth. And the combination of those two informed my approach to investing. All my memos are available online at oaktreecapital.com. And if you go back about 20 years ago, you'll find one called What's It All About Alpha, which talks about how I juxtaposed the quantitative and the qualitative and the practical and the theoretical, and how I applied what I learned in those 6 years of school in my career in the real world. It's for me, the education was, you don't learn everything you need to know in school, but you get a springboard. You learn a little bit about how to think.
All right, so our next question comes from Ethan.
Hi. In regards to evaluating investments, which aspects matter more, the micro or the macro, and why is that?
Well, that's an interesting question, Ethan. And it's what I don't know if you still use this expression in your school, but it's what we used to call the trick question, because the macro is more important, but the macro is not knowable. And very, very few people in the world, if any, have a superior predictive ability with regard to the macro and can consistently get it more right than others. I had dinner with Warren Buffett a couple of years ago, And he said to me, for a piece of information to be desirable, it has to satisfy two criteria. It has to be important, and it has to be knowable. And I believe that the macro is important, but not knowable. The micro, on the other hand, is something that through hard work and skill, you can be superior at. The micro is knowable. It's even, in my opinion, knowable in a superior way. So, given the fact that I'm not a believer in macro forecasting, I stick to the micro, and that's what we do at Oaktree. We say we try to work on the knowable. And the things that are knowable to a greater extent than others are companies, industries, and securities, but not economies, markets, currencies, and interest rates.
Okay, so we have about
just 1 second, Rowan. Last word. If you're going to spend your time in the investment business, you should spend your time trying to know something that other people don't. Superior success comes from superior insight, from knowing something others don't. You're unlikely to know anything that others don't about the macro. It's possible through hard work and skill to know some things that other people don't about the micro.
Okay, so we have left, and my final question is, what overall advice would you give to students looking to become successful investors? Like, what final advice you have?
Well, my advice for you is very simple. It's a great field. It's not for everyone. There is no single profession that's great for everybody. Investing, I've spent 50 years doing it. I find it fascinating. As you can see, if you've read my memos, you could read Risk from 2006 and Risk Revisited again from, I think it was 2015, and you can see over those 9 years. Now, I wrote the first one. I was already in the business almost 40 years, and yet when I wrote the second one, I knew a hell of a lot more than I did when I wrote the first one. So the point is, you learn, you grow, you evolve, and you refine your thinking. And that's a great thing. It means that you're always learning and you're always expanding your consciousness. You're always challenging yourself. You never know it all. Now, there's a great book called Fooled by Randomness. I don't know if anybody's read it, by Nassim Nicholas Taleb. And he always compares investing to dentists because he's talking about the role of randomness. And there's a lot of randomness in the world that affects us, investors, and we have to try to have portfolios that are armored against randomness, but it's very hard. He compares that to dentists. In dentistry, he says, there is no randomness. You learn how to fill a tooth. You fill a tooth the same way every time. You get the same result every time. No randomness, no change. The results that produced a good filling last year will produce a good filling next year. So that's what makes investing interesting to me. Some other people may not enjoy it. People, for example, who are interested in the physical sciences might say, I want something where I can find a solution which will always be correct. That's not investing. The things that worked yesterday in investing may fail tomorrow because the world changes. The actions of your fellow investors alter the world you live in. So if you want certainty, don't become an investor. If you want challenge, maybe you should. So try it. Try it on your own. The great thing is, and you don't even have to do it with money. Try to find a security. Write down what price you, quote, bought it at. You don't even have to buy it. Just what price you liked it at, when, why. And then a year later, take a look. Were your judgments correct? Did it go up? Did it go up more than the market, etc.? So you can assess whether you like these things. And your goal, the fact that you're in this class listening to me, proves that you're highly intelligent and highly motivated and even interested in growing. And chances are that you are going to have lots of choices in life. Your goal should be to do something that you enjoy and can get fulfillment at. I would discourage you from doing the thing where you think you can make the most money. You only get one life, and you shouldn't squander it on doing things that are not pleasant just to make money. You should try to maximize your fulfillment in life by doing things you'll enjoy and be rewarded by. And that's really my advice, Rowan.
All right. Thank you for coming to speak to us today.
Okay.
Great session. Yeah. A recording of this will be made available online if you want to, rewatch it for some of the insights he gave. But yeah, thank you all for coming, and thank you to Mr. Marks for coming to speak.
Well, thanks for conducting it. Good job, Rowan. Good job.
Thanks. All right.
Okay,
All right.
bye-bye.
Talk to you soon.
Yeah, bye.
Bye.